Hey, what's up, guys? This is Courtney, your Flex Financial Trading and Wealth Coach. Again, thank you guys for joining the Mastering Cover Calls course. Of course, we're going to dive into cover calls, all the ins and outs, everything you need to know to generate monthly, weekly income in your own portfolio. But before we do that, since cover calls is an options trading strategy, we got to give you the basics of options, and we want to give you a quick introduction to options. You got to know how they work and how to use them before you can start leveraging and using them with the cover call strategy. So we want to make sure we're covering all bases and give you a quick introduction to options before we dive into cover calls. So let's go ahead and let's get into it. So first of all, simple question: what are options, right? Options are contracts that give you the right, not the obligation, to buy or sell a stock at a specific price before a certain date. Now, there are two types of option contracts available that you can trade. You can trade call options, and call options give you the right to buy a stock, and you can also trade put options. Put options give you the right to sell a stock. Now, options are considered derivatives, meaning they derive their value from an underlying asset, in this case, typically a stock. Now, the key takeaways from options is really options give you flexibility, they give you leverage, and they give you strategic control over your trades. Now, some basic options terms that you really need to know before you start trading options and using them with cover calls. First of all, options have something called a strike price. That is the price at which you buy or sell the stock. And the nice thing is you have a lot of control over where you choose that strike price. Also, second term is expiration dates. Every option has an expiration date. That is the last day that the option is actually valid and you can actually trade the option. Third, third term you need to know is premium. Now, premium is the price you pay to buy the option. Obviously, we're buying and selling options. There's a cost associated with that. That is called the premium. Very simple. Also, the fourth term that you need to know is in the money. Now, in the money means that the option has intrinsic value. Also, a good way to put it is the strike price is lower than the actual current price of the stock. So that means the option contract is in the money, right? So it has intrinsic value. That means it's actually really worth something, right? Then you also have the term called out of the money. That means that the option has no intrinsic value. So that means the strike price is higher in terms of call options. The strike price is higher than the current price of the stock. So that means that the option is out of the money. It doesn't have intrinsic value just yet. But as that stock price moves up or down in value, so does in an option contract where they can become in the money or out of the money or vice versa. So very important to know these terms. Strike price, the price at which you buy the stock or sell the stock. Expiration date, every option contract has an expiration date. That's the last day that you can trade, buy or sell the option. Premium is just the price that you pay to buy the option contract, or in terms of selling contracts with cover calls, you collect premium. And then in the money, the option contract has intrinsic value. Out of the money, the option contract does not have intrinsic value just yet. Now, why do we trade options? Options provide leverage, right? They can provide leverage that allow you to control 100 shares of a stock at a fraction of a cost, right? So if you went out and bought 100 shares of a stock, that can cost a lot more capital. So you can leverage options to control 100 shares without putting up as much capital to trade them, right? That's why a lot of people really like options. Also, options provide an opportunity for income. They allow you to generate monthly cash flow using strategies like cover calls. Again, that's what this course is all about. We're going to get into cover calls. It's very exciting to show you how to generate that weekly and monthly income in your account. So options are very good for income generating strategies. Also, options can be used for hedging. They can protect your portfolio against losses. So a lot of times people like to buy put options just in case the market or the stocks go down. That provides sort of a hedge, especially when you're buying stocks and you're long stocks. You want stocks to go up. If that doesn't happen, you have some put options on hand, or maybe you're doing option spreads for some of my more advanced traders out there that allow you to hedge against your portfolio and hedge against potential losses. Then lastly, options provide flexibility. You can profit for any direction in the market, really, depending on the strategies that you're using. You can profit in a bullish market, you can profit in a bearish market where stocks are going down, and you can profit where stocks aren't moving, right? They're just going sideways, depending on the strategy. There's option strategies capitalize on all different directions in the market. So a lot offers a lot of flexibility when it comes to trading options. Now, some basic options trading strategies that are good to know. First of all, cover calls. Obviously, that is a big focus of this course that we're checking out today. This strategy is great for beginners. Really, it's great for all levels, right? There's all different levels that use cover calls to their advantage. It's a great income generating strategy where you own the stock and you're selling call options and you get paid a premium. The one thing to remember is you may have to sell that stock at the strike price. So on this particular strategy, really you want to do it on stocks that you're okay parting ways with in your portfolio. And again, this is an awesome income generating strategy, weekly and monthly in your account. And again, we're going to dive a lot deeper into that as we make our way through the course. Also, buy and call options. That's another basic option strategy, just a simple bullish strategy. You think the stock is going to go up, you want to participate in that move to the upside, and you don't want to necessarily go out and buy 100 shares of a stock. Well, you can go out and buy call options. It's a lot cheaper to do it, and it's a small upfront investment, and you have higher potential returns because the investment is small up front, right? So you can generate massive returns really if you're getting in on the right moves to the upside. But then keep in mind, there's also options can be risky. You can risk a total loss of your entire investment depending on the options you're buying, the expirations you're buying, and the strike prices you're choosing. So you got to be very, very careful when it comes to buying call options. Third strategy is a basic strategy for options is buying a put option. Now, this is a bearish strategy where you think the stock is going to go down or the market's going to go down, and you want to protect or you want to protect your portfolio, your long positions, and you want to hedge. Then you would buy put options to capitalize and profit as stocks are declining. It's kind of like buying insurance for your stock, right? You think overall you're bullish, you want the market to go up, but just in case, you're buying put options to kind of hedge against any short-term losses in your account. And then lastly is option spreads. Option spreads are a little more advanced of a strategy. We use a heavily used strategy called bear call spreads, which we'll probably do a course on that here a little later down the road. But option spreads are where you buy and sell multiple option contracts at the same time to limit risk and or cost. Spreads involve two or more options of the same type. So you can buy and sell a call option at the same time or put options at the same time. Typically, they have different strike prices, and sometimes they'll have different expiration dates depending on the type of strategies that you're using. But those are your four basic option strategies: cover calls for income, buying a call option when you think the market is going up or your stock is going up, you want to capitalize, buy call options, buying put options when the stocks are going down, the market's going down, and hedge your portfolio. And then option spreads that are a little more advanced of a strategy where you're buying multiple contracts of calls or puts, right? So a little more advanced of a strategy. Again, we'll probably do a course on that. So stay tuned on advanced strategies. Now, options can be very, very risky, right? So keep that in mind. Some things to watch out for. Options can expire worthless, right? You lose the entire amount of premium that you paid to buy the option. That is a possibility. So you always have to keep that in mind. Also, options have short-term time frames and that can cause rapid value in decay, right? In value decay. And that's known as time decay. So since they have those expiration dates, the longer that you hold an option contract, the time eats away at the value of that option contract, especially if the stock is not moving in the direction that you would like it or need it to go. Then time can really, really eat away at the value, and that is called time decay. So you got to be aware and watch out for that when it comes to trading options. Also, over leveraging with option contracts can lead to large losses. So I've seen this time and time again because option contracts are less expensive to kind of trade. A lot of times traders want to pile in and buy a ton of contracts, go all in on contracts. You got to really manage your risk when it comes to trading options. Otherwise, you can put yourself in a really, really bad spot and lead to large losses and blow up your account. So I've seen this happen over and over and over again. So you gotta be very, very risk conscious when it comes to trading options. Then not all stocks have liquid options. So not every stock has a full option chain, and you got to really pay attention to stocks and options that have low open interest and low volume because there has to be demand, right? There has to be supply, demand. There has to be demand for the option to actually sell it and get a profit out of it. So if you don't have that, then those are the type of options and type of stocks you want to stay away from when it comes to trading options, right? So not all are liquid. You don't want to get stuck holding an option contract that you can't get out of because there's no demand for it. So those are some things that you really need to keep in mind when it comes to trading options. Now, quick example for options, an options trade. Let's say that you buy a call option contract, XYZ stock, in this hypothetical stock, in this hypothetical situation. Let's say you buy that call option and the strike price is $100. The premium that you pay to buy that contract is $2 per contract. Now, keep in mind, every option contract has a multiple of 100 because you're owning 100 shares or you're controlling 100 shares. So that $2 per contract, if you multiply that times 100, really that means that that option contract costs $200 to buy that option contract. And let's say the expiration date is 30 days from now. Those are the criteria of what we bought, right? Strike price $100, $2 per contract. So really, that's $2 times 100. So that contract costed us $200, and it expires in 30 days. Now, let's say in this scenario that XYZ stock goes up to $110 before the expiration date. Now your call option is now worth $10, right? But let's keep that in mind. Again, that's $10 times 100 because you're controlling 100 shares. So really, that option contract is worth $1,000 in terms of if you sold the contract. So that would be a profit of $1,000 for its current worth, right? Again, XYZ stocks trading at $110. The contract went up to $10 in value. So essentially, that's $1,000 contract minus the $200 that you pay for it. So your profit, your net profit, will be $800 in this particular example, and that's simply just from buying a call option. The stock goes higher in price. Remember, option contract is a derivative of a stock, so it's going to follow that stock to the upside, and the value is going to increase, and your profit is going to be $800 in this particular example. Very, very simple trade, and that happens all the time. So that is it. That's a quick breakdown of options, right? The simple, everything you need to know of options. Very, very simple introduction there. So now what's next? What can you do with this information? You can start paper trading options to learn how to kind of manage risk with your trades, and you can do that without risking your own money. Paper trading is a great thing to kind of get the mechanics down, to make sure you're clicking the right buttons, and you don't have to be nervous about losing money. A lot of brokers out there offer paper trading. Also, you want to learn the Greeks, and that's going to help you understand how options fluctuate in value. And in the next video, the next training video here, I'm going to give you a quick overview of the Greeks because it's a must know information about options because you want to really understand the intricacies of how they move. And we're going to cover some simple things about the Greeks. So stay tuned. Make sure you click that next video here in just a minute. And then also you want to use a trading platform like Thinkorswim. That's the platform that we use. And you'll see here in the training videos that you will share our screen and you'll see Thinkorswim there, or E-Trade for trading options, or really whatever platform that you're comfortable with, and broker that offers options trading. But if you're open to Thinkorswim, that is a great platform. We've been using it for many, many years, and you can follow along with the trains lot better when using Thinkorswim. And then lastly, you want to focus on strategies, option strategies that align with your specific goals, right? Whether they're income strategies like cover calls, whether you're looking for growth or protection. If you're looking for growth, you're buying call options, maybe longer dated options like leaps, or you're looking to hedge, you're looking for protection, you're looking to buy some puts and protect yourself to the downside. Overall, you need to understand what your clear goals are, what you want your portfolio to do, and you want to plan accordingly. But for the sake of this training, I hope you're looking for an income strategy because we're going to really dive in on how to master cover calls. So continue to stay tuned with us here in these next videos. And again, next I'm going to break down the Greeks. So click that next one. Thank you guys for tuning in. We'll see you on the next one.